It's easy to get stuck in the cycle of waiting for the right moment to start investing. You think, I'll wait until the market calms down, or once I have a bigger savings cushion, then I'll start. The problem is the perfect moment never comes, and every year that goes by is a missed opportunity to build something bigger for your future. In this video, I'll show you exactly how I would start dividend investing today without waiting for the perfect moment. We'll dive into how dividends work, how reinvesting them builds wealth over time, and how you can create a simple, effective portfolio without needing a large upfront investment. And in the end, I'll show you how just $25 a week invested into that portfolio could grow into a $1.6 million portfolio that pays over $5,000 in monthly dividend income. But before we get there, let's take a quick look at what's going on in the world financially. For a lot of people, financial stress isn't just something they think about, it's their everyday reality. On paper, things might look fine. The median household income is about $86,800 a year, which seems pretty good, right? But when you compare that to what people actually have to pay for, you start to see the problem. Take housing, for example. The median home price in the US is around $422,000. But to afford that home comfortably, you'd need to earn around $94,000 a year. Right away, there's a gap. People are working hard, doing what they're supposed to, but it still feels like they're falling behind, and the pressure isn't easing. Home prices went up 0.9% last year, and we're expecting another 4.5% increase heading into 2026. On top of that, everyday costs are rising too. Energy bills, for instance, are up about 6.7%, and natural gas is 10.8% more expensive than it was last year. Groceries, utilities, insurance, these are things we can't just choose not to buy, and they keep getting more expensive. Meanwhile, wages aren't growing as quickly. It's like trying to run on a treadmill that's speeding up faster than you can keep up. This isn't just a budgeting problem. 9 out of 10 Americans feel like we're in a cost of living crisis, with half of us struggling to pay rent on time and the same number finding it difficult to afford basic groceries. Things got more expensive in 2025, and many believe they'll keep getting worse. What makes this even tougher is that most households rely on just one income source. If that paycheck slows down or stops, everything feels fragile. Raises don't make things easier. They just get swallowed up by higher rent, more bills, and more pressure. The financial stress never really goes away. This is where dividend investing can really make a difference. It's not about finding a quick fix, but about creating a steady flow of income that doesn't require working extra hours. Dividend investing shifts the focus from earned income to ownership income. When you start earning money from things you own, even in small amounts, it changes how you think about money, risk, and what's possible in the long run. Now, let's dig into exactly how dividends work and how they can help you start building that ownership income. So what exactly is a dividend, and why does it matter so much in this conversation? At its core, a dividend is simply a company sharing part of its profits with the people who own it. When you buy shares in a company, you're not just hoping the stock price will go up. You're an owner, and dividends are the company's way of paying you for that ownership. Some companies pay dividends every 3 months, some monthly, but the idea is the same. Cash shows up in your account just for holding on to your shares. But what's important here isn't finding the biggest payout right now. What matters most is finding companies that can consistently pay dividends and raise them over time. This is where dividend growth comes into play. Think of it like getting a raise at work every year without having to ask for it. If a company increases its dividend each year, your income goes up, even if you don't add any more money. Over the long run, these yearly increases add up way more than starting with a high yield that never grows. And it doesn't stop there. As strong companies grow, the value of your shares tend to grow too. So now, you're not just earning income from dividends, you're also seeing the value of your ownership rise. That's the beauty of dividend investing. You can have both income and growth working together. When dividends rise and share prices increase, your income and your portfolio grow hand in hand. That gives you real flexibility, and the more time you give it, the better it gets. And here's where the magic really happens. Once your dividends start rolling in, you can reinvest them to buy even more shares. That's compounding, making your money work for you over and over again. Let's put this into perspective. Suppose you invest $10,000 in a dividend stock or ETF paying 3% a year. That means you'll get about $300 in dividends in the first year. If you take that cash and spend it, that's the end of the story. But here's where it gets exciting. If you turn on DRIP, Dividend Reinvestment Plan, that $300 will automatically buy more shares of the same stock. Now, instead of ending year one with the same number of shares, you have a bit more. It doesn't feel like much at first, maybe just a fraction of a share or a few extra, but here's the key. Those new shares will also start earning dividends. By year two, you're not just earning dividends on your original $10,000. You're earning dividends on $10,300 because of the $300 you reinvested, plus any increase in the stock's price. With the same 3% dividend, now you're looking at about $309 in dividends. It's just an extra $9, but that extra $9 comes from the last dividend. This is the loop. Dividends buy shares, shares produce more dividends. Those dividends buy even more shares. And if the company grows over time, the share price rises too, meaning each reinvested dividend is buying assets that are becoming more valuable. Now layer in dividend growth. If that 3% dividend grows by, say, 10% per year, the income doesn't stay flat. Over time, each share is paying you more than it did before. So you're owning more shares and each share is more productive. That's why compounding feels invisible early on. In the first few years, it feels slow and almost boring. But after 10, 15, 20 years, the growth accelerates. This is where most of the results actually come from. In the end, I'll show you a portfolio that maximizes the power of compounding and could potentially turn $25 a week into $1.6 million, paying you over $5,000 in monthly dividend income. But first, let's have a look at the core dividend strategy. Once you get the hang of how dividends work and how reinvesting them grows your wealth, the strategy itself is pretty straightforward. The goal here isn't to chase after the latest stock tip or try to time the market perfectly. It's about building a system that's simple enough to stick with for the long haul. Instead of asking which stock will double next year, the better question is which businesses can keep paying and growing their dividends through different economic cycles. Companies that do this usually have stable cash flow, strong demand for what they sell, and management that prioritizes shareholders. Of course, this kind of investing isn't always smooth sailing. Some years will feel slow, and sometimes the market will go sideways. That's part of the deal. A dividend strategy works through all the noise, not around it. Even if stock prices fluctuate, dividends usually keep rolling in, and reinvestment continues to add more shares to your portfolio in the background. What's important here is consistency. It's more about investing a fixed amount regularly than trying to time the market perfectly. Even when things feel uncomfortable or uncertain, sticking to your plan, investing the same amount every time, creates a habit that pays off in the long run. It's this habit that does more for your portfolio than any quick moves or expert predictions. Another key element of a solid dividend strategy is balance. You don't need to invest in dozens of companies to make it work. A small group of high-quality dividend-paying stocks spread across different industries gives you plenty of resilience without complicating things. It's all about keeping things simple and steady. Even with a solid strategy, many investors run into trouble because of a few common mistakes. One of the biggest is chasing yield. A very high dividend can look tempting, but it's often a warning sign. If a company is paying out more than it can afford, that dividend is at risk of being cut. When that happens, both your income and the share price usually take a hit. Another mistake is ignoring dividend growth. Some investors focus only on income today and forget to ask whether that income will grow. A flat dividend loses purchasing power over time as inflation eats away at it. Over-diversification is another trap. Holding too many stocks can dilute your best ideas and make the portfolio harder to manage. Putting too much money into one stock or one sector creates unnecessary risk. Many people panic during market downturns. When prices fall, they forget that dividends are still being paid and reinvested at lower prices, which is a huge plus. Selling in those moments locks in losses and breaks compounding. Here is how I select dividend stocks. I start with reliability. The company needs to have a long history of paying dividends through different market conditions, which tells me it generates real cash and manages it well. Next is dividend growth. A growing payout signals progress. Even steady growth, compounded over time, turns into meaningful income and protects purchasing power. I also look for share price growth. A rising business makes your ownership more valuable and strengthens reinvested dividends. Strong balance sheets and dependable business models tie everything together. When you find companies that combine consistency, growth, and quality, investing becomes a lot more predictable. With the selection criteria clear, here is how I would actually build my dividend portfolio if I were starting this year. The first one I'd choose is Schwab US Dividend Equity ETF. This ETF acts as the backbone of the portfolio. It gives broad exposure to high-quality dividend-paying companies, providing instant diversification. Right now, it's yielding about 3.38% and has had a pretty solid 10-year growth rate of 10.61%. Plus, the share price has been growing by around 9.81% each year. It's a nice balance of income and growth, and I don't need to pay constant attention to it. Next, I'd go with AbbVie. It's a bit more of a growth play, but still with a solid dividend. It pays about 3.16% right now, and it's been growing its dividend at 12.22% over the past decade. On top of that, its share price has been increasing at about 15.53% a year, so I get both income and growth from this one. 2 birds, 1 stone. Then there's Morgan Stanley. It's a bit of a slower yield at 2.27%, but this one really shines in the growth department. Over the past 10 years, its dividends have grown by 20.66%, and the stock price itself has been appreciating at 23.06% a year. This one is more about building wealth over time rather than income today. Then I'd go with Interparfums, which adds a bit of variety. With a yield of about 3.17% and a 10-year dividend growth rate of 20.16%, it offers a nice balance of both income and growth. Its share price has grown at about 14.64% annually, showing how a smaller niche company can compound value and dividends. Finally, I'd include AGM, which brings stability and exceptional dividend growth. AGM offers a 3.5% yield and has an impressive 25.08% dividend growth rate over the past decade. Add an annual share price appreciation of about 18.9%, and this stock becomes a powerful income engine for the long term. Now let's see how this all works when we add it all up. Since I've picked 5 stocks, each one makes up 20% of the portfolio. To find out how the portfolio performs, I average the dividend yield, dividend growth, and share price appreciation of each stock. For dividend yield, I add up the individual yields: 3.38%, 3.16%, 2.27%, 3.17%, and 3.5%. That totals 15.48%. When I divide that by 5, I get an average dividend yield of 3.1%. So on average, my portfolio is paying me 3.1% in dividends. The same process applies to dividend growth and share price appreciation. Add all 5 values and divide by 5, resulting in 17.75% dividend growth and 16.39% annual price appreciation. This shows how the portfolio performs as a whole. Now, with those numbers in mind, let's take a look at what this kind of portfolio could realistically turn into over time. Let's say I invest $25 a week into this portfolio. By the end of year 1, I would have invested around $1,300, assuming 52 weeks in a year. Looking ahead, projections show that by year 10, the portfolio value would be approximately $33,000. At that point, the dividend income would be around $1,000 per year. Fast forward to year 20, and the portfolio is projected to grow to about $243,000, with dividend income climbing to roughly $8,000 per year. This is where the momentum will really start to pick up. By year 30, the curve is projected to bend sharply. The portfolio value would exceed $1.63 million, with dividend income reaching $62,000 per year, or about $5,200 per month. This would be enough to comfortably cover daily living expenses and then some. Want to know how to double your SCHD income with a simple strategy? Click the video on screen to find out how.